Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And he said to me, he was like, how much money do I need to retire? And I said, well, how much money do you need to spend? What kind of lifestyle do you want to have? And he said, no, I need to know a dollar amount. What should I be working towards? And I said, it completely depends. People think of it backwards. We get this question all the time, right? AAA, all the time. Daniel,
That's right.
How much money do I need? What's the number? And I don't give it to them. Even people in our industry, they're baffled that we don't have that number because they're thinking about it backwards. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Welcome back. And this week's rendition is retirement. Why everybody wants income. It's all about the income, right, Daniel? That's the whole point. People don't get it. It's such a simple thing, but they want to make it more complex than it really is, right? Well, how much money do I need? What matter? It doesn't matter if you got $1 million, $2 million, $3 million, $5 million. That doesn't matter. The thing is, what matters most to you and how much money is it going to take to do that? And usually that's in the form of an income, a monthly check to replace the check that you're losing because you're going back to, or you're stopping work, right? So it can be so simple, but people tend to make it so complex. It's all about the income.
Yeah, you need that number, but not the number you're thinking of. You need the number that will give you the lifestyle you want to have. And then we can fill in all the pieces to get you that lifestyle, right? But people are so different. And inevitably, as soon as you start talking about it, someone will say, well, what is it? A 3% withdrawal rate now or a 4% withdrawal rate? Or if I listen to Dave Ramsey, an 8 or a 10% withdrawal rate. And they say, no, withdrawal rates are useless because that's depending on old information, right? That's pretending on historical information that may or may not be true in the future. So a withdrawal rate is not going to help you. Right? And people intuitively know this. That's why the show is called Why Everybody Wants Income. They know they want it somehow, and people are doing this complex stuff to try to generate the income that they need or that they want. But they're doing all these weird ways instead of going back to the basics, right?
Right. Puts and calls, engineered products, engineering income by withdrawing money is not true income, and that's so many times what people think. They think, well, just the other day, a tax person called me up and said, how much is he going to have to take out of his retirement plan to live? I said, you got it wrong. He's not taking it out. He's leaving everything in his retirement plan. He's just going to start receiving the interest and dividends, the income from this thing. Just like, our parents used to say is live off the interest, not off the principal. And today, too many baby boomers, too many financial people are getting people living off the principal rather than off the interest, the dividends, the income. Like it comes razor, right? Is the idea of the simplest solution is almost always the best answer, right? And this is so simple, it's complex. Because people say, how do I get my head around this? Because they're so used to looking at that bottom asset number. And then when we show them the number right next to it, which is how much income they can get the rest of their life, that they're like, okay, now what does this mean? This is what I'm going to be withdrawing from here. No, that's what you're just going to be getting. I love that, as you know, Daniel, I love the analogy of the chickens and the eggs, right? And the assets are the chickens. And the income, the dividends and interest are the eggs. And as long as you just use the eggs or less than all the eggs, you're never going to run out of money, right? Because it's a renewable resource. And it's really a simple concept, really simple.
Yeah. And so people intuitively know this and they look for ways to generate income. The difficulty comes in, two things. One is they're worried about running out of money. And the reason people close to or in retirement are worried about running out of money, or if their money will last their life, or they stop spending in recessions, or they don't have the lifestyle that they want to have. It's all these different things that go back to the same fear, running out of money in retirement. And it's because they're not living off of interest and dividends. They're doing the withdrawal methods, or they're taking lump sums to do things that they want to do. And so it's dependent on what's going on in markets, right?
Right.
The second part of that is, who is there to teach people about this? Right? There's nobody teaching it. We have countless stories of people saying, I asked the advisor, I asked this person, how do I get income? And they don't know. They told me to get a Vanguard bond fund. They told me, we put it into ChatGPT ourselves, and it came up with all the things everybody already knows about, right? It came up with Social Security.
Right.
It came up with Social Security. And if you're depending on that, I'm sorry, you got some problems looking ahead, right? You got to have a backup plan. Came up with pensions. And if you're blessed enough to have a pension, well, you already know about that, and you're really probably excited with that. But you can build your own pension, and a lot of people don't know that. If you have retirement savings, you can build a pension. If you sold a business, you can build a pension. If you own a business, you can build a pension, right? But like, it doesn't tell you anything about that. It just says a pension.
Right. Right. And even if you're employees, right? You can have a private pension plan that's available, but people don't know how to do it, and you need some help. So I get it. Yeah. So you're on the right track. It doesn't
tell you any of that. It's like, if you already know you have a pension, well, you're in good shape, right? And then we've got investment income, but it's just talking about stuff everybody knows about: dividends, stocks, bond mutual funds, bond ETFs, right? These are not going to give you the confidence that you need in retirement. It doesn't even talk about owning individual properties or multifamilies that you can generate real estate or income from. And then you can go get a part-time job. So that's Chat GPT's wisdom for you. I think everybody already knew that. And that's the problem. It's just it's not thinking, it's gathering information. I know everybody thinks AI is already thinking. It's just gathering all information that's known, the most popular information. It's taking a big data set and it's spitting something out. So that tells us, what does that tell us? That the people who are talking about it don't know what they're talking about, because it doesn't say the important stuff, right? Does it say anything? Does it say anything about these preferred stocks that Synchrony Financial just issued, JP Morgan just issued?
Well, you're getting yeah. Okay, Daniel, slow down, slow down, man. You got a live fire lit underneath. You're listening to Financial Strategies with Andrew and Daniel Agemy, and as you can tell, we're excited about today's show. Why everybody wants income, and it's all about the income when you're in retirement, not about the assets. It's about the income. Maybe what the assets can generate for income, but it's about the income. And we're glad you're listening to us. We're Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And just like Daniel said, even AI doesn't know because people don't know. So AI doesn't know. So therefore, people are not going to know. So that's why you need to listen to Financial Strategies, because you're going to hear stuff and know stuff and find out about stuff and be educated on stuff that you're not going to get, generally speaking, any other way. Or at least you'll know what you don't know. So we have a paper to go along with trying to educate you and helping you understand what you don't know. And it's called Passive Income for Retirement. And it's just about 3-4 pages. That's easy read. We love to put that in your hand. You can have that for free by calling us at 800-725-7616, 800-725-7616. You listen to Financial Strategies, because people don't know what people don't know. And today's topic is retirement, why everybody wants income. Okay, Daniel, so you're talking about what AI is saying, right? And you're saying that AI doesn't talk about pensions. It doesn't talk, well, it does talk about pensions. It does talk about Social Security, which is not going to be enough for most people. Most people don't have pensions, but people don't know. It doesn't tell you, oh, you can do your own private pension plan, or you can develop a pension plan for you that you'll be able to have an income, guaranteed income for the rest of your life. It doesn't tell you that. It says, oh, you can withdraw from savings. Who in the world wants to withdraw from savings in retirement? That's the whole point. That's how you run out of money, by withdrawing. That's so. And then, investment income, it says, well, you can have investment income. You can generate dividends and interest from stocks, bonds, mutual funds, right? But mutual funds are not going to do it for you, right? Which we'll talk about that Vanguard one, Daniel, that is so egregious that is out there. People love Vanguard because it's so low fees and everything. But guess what, guys? You get what you pay for. Part-time, and then of course, what you didn't say is AI throws in there is part-time work or consulting, right? Which some people are able to do that or want to do that. right? But that's
Yeah.
not for everybody.
Right.
And-
Some people love what they're doing. Yeah, it's
Right.
totally fine.
But what we're talking about, generating true income, like what you were just saying, I forget what company you mentioned, in offline, you talked about Goldman Sachs, and did you just talk about JP Morgan or talk about one of those companies? But, there can be some very simple things that are there, right? Like what's simple?
Well, what's simple is things that have two contracts associated with them, right? I'm going to pay you X amount for a certain period of time, right? People are used to these with CDs, but there's government bonds that do this, there's corporate bonds, there's preferred stocks, and then there's a whole bunch of other things, real estate too, but again, not a real estate
Right.
investment trust, owning a house, owning
Right.
a property. You have a lease. It works like that. You have a
Right.
lease, and as long as that tenant is paying you income, you've got income coming in, right? You have to manage that yourself typically. But some of these things we're talking about, the preferred stocks, for example, is something most people know nothing about.
Right.
And we were going through like Goldman Sachs. Anybody heard of Goldman Sachs? Pretty good, pretty big company.
Goldman
They
Sachs.
just issued a
heard of them?
preferred stock, right?
Yeah.
They just issued a preferred stock that's tax efficiently, right?
Wow.
So it's not taxed like a bond where it's ordinary income. It's taxed at like a long-term interest or a long-term capital gain rate, right? And it's
Right,
paying
right.
7.5%,
Wow.
right?
Nice. Yeah.
So these are the kinds of things that we'd like to get into, and we'd like to tell people there's this whole universe of things like that, right? Citigroup 7.2. Anybody heard of JP Morgan 6.8, and then Synchrony Financial? They just issued a preferred stock paying 8.25.
Whoa.
That's big income, right? And this is simple.
Yeah.
You buy it, you sit back,
Yeah.
you collect income. There's not leverage. There's not funds of funds. There's not complication on buying and selling puts that you can lose your whole principal because something blew up. It's not volatility stuff. It's not transferring liabilities from the company's balance sheet to your balance sheet. It's simple. You buy it, they pay you, you sell it, or it comes due when you'd like it to.
So lower risk too is what you're saying. Lower risk. So here's the idea, right, Daniel? You take $10,000, you buy one of those preferreds that you were just talking about, and you get $820 a year in dividends and interest every year. $820 on that preferred. You hold that preferred for 10 years and you get $8,200 over that period of time. And then the company wants it back and they pay you your 10 grand back.
Right.
So you almost doubled your money for just investing it. Wow. That's a beautiful chicken,
That's
right?
if you're collecting income, AAA. If you had compounded that, it would have
and
more than
reinvested
doubled.
it, it would have been more than if you reinvested it.
But
beautiful.
that's just you sitting back and collecting and spending the 800,
Right.
Spending the $825.
Right. So, the people who are close to retirement, like 50 years old, 55, 60, whatever, have not yet retired, that money's compounding and we're taking those eggs, so to speak, we're buying more chickens and then we get more eggs. Right. But for those people who are in retirement, well, maybe they're receiving that or they're receiving part of it. And therefore, if they're receiving part of it, we're taking the part that they're not receiving and we're buying more chickens and thus getting more eggs and compounding it that way. And so it's really a simple thing, but it's something that people don't know about. It's not simple because people don't know what they don't know. And that's why you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Where in the world is Andrew and Daniel today? Well, Andrew's in Connecticut today in the mobile office in Connecticut. And Daniel, that's a nice looking background you got there.
Yeah, I'm here in my office in Colorado, right outside Denver, and excited for a good show today. But you got a new backdrop.
Right. Well, that's what I said. I'm in the mobile office in Guilford, and I've got a new mobile office, and it's all good and moving forward. So We have today for you listening to our show, today's topic is retirement income or retirement, why everybody wants income. We have a book to go along with today's show called Common Sense Income Strategies by our friend Michael Easom, CPA, PFS. Michael's put together a great book that we love to give to people that helps them understand the simplicity of what we're talking about. It's not simple because you don't know about it. But once you read this book, you're going to see a little bit more how simple it truly is when you come down to the basic principles of living off interest and dividends as opposed to principal. Well, we love to put this in your hand for free for calling us 800-725-7616, 800-725-7616 for your free copy. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
So when my boys were young, Daniel, you remember this, you were part of a scouting troop called the Royal Rangers, and Royal Rangers' motto was ready for anything. And, the whole thing about scouting, right, is the idea of, you hope for the best, but you plan for the worst so that you're ready for anything. And, when it comes to people's retirement plan, I talked to, one person in particular that I'm thinking of. And, we went through this whole process of planning for the worst or hoping for the best, but planning for the worst. And at the end of the conversation, she basically just said, well, I'm going to hope for the best and I'm going to plan for the best. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about why everybody wants income. And AAA, when we're talking about why everybody wants income, we are talking about people who are in retirement or close to retirement. Obviously, if you're going to a job, you want some income from that job. But what we're talking about is how you can create income from your retirement assets so that you can retire, stay retired, and have confidence that paycheck's going to keep coming in.
Right.
That's what we're talking about when we're talking about preparing for the worst, right? Hoping for the best, but preparing for the worst. And what's happening right now is people are getting lulled into sleep because the market has done so well for so long. And we have had these dips, right? The plunge protection team comes in and pumps markets back up, and people are like,
throw some sugar in,
go up.
Steroids. Yeah.
So much
high
to the
coffee,
that
caffeine.
So much to the point where people think that the S&P can only go up. People are saying it's bond-like again. Like this was happening, pre-COVID. People were saying it's like a bond. It's like a long-term bond. People are starting to say those kinds of things again. And it's really silly. It's nothing like a bond.
That's right. Nothing.
But
it's a story.
People are starting to say that. And I was talking to a doctor the other day who was saying, well, isn't it like impossible to beat the S&P? Hedge funds can't even beat the S&P. And I was like, no, it's a well-oiled marketing machine that's convincing everybody that. And as long as everyone's convinced of that, money will continue. And as long as the U.S. is the best place to put money, will keep going into the S&P and it will keep driving it up. But that sounds like a game of musical chairs to me. That doesn't sound like protecting yourself from unexpected events. That doesn't sound like protecting your retirement funds so that you can have a retirement, right? That just sounds like social investing. We'll all put our money into here and it'll keep going up. But as soon as somebody starts pulling out, or as soon as people start getting scared, the majority is going to get left in there, right? And you don't know what you'll be able to sell it for.
Right. That's right. It's a story, Daniel. It's just a story. It's a story that Wall Street firms put out saying, the market always goes up. Well, guess what? It does for the companies. but not for individuals, because individuals have lifespans. And if you've ridden the market up for the past 30, 40, maybe 50 years, well, guess what? It's not going to keep going for you, because you're going to have to start taking money out. When you have to take money out, it's a different story. It's a different deal. And the thing, and like you're saying, Daniel, those people are saying, oh, the S&P is like bond, like, no way, right? Bonds are contracts. There's guarantees. There's promises, right? And there is no promise with the S&P. There is no contract with the S&P. There's nothing guaranteed about the S&P at all. Excuse me. Yeah, there is one thing you're guaranteed with the S&P 500, that you're going to lose money on one day. One time, sometime. Now, you may not sell, so it may come back. But if you need the money, want the money for retirement, that's not going to work. And that's how people run out of money, because in their retirement, because they keep investing it the way they've always invested it when they were younger, which worked well for them. And they think, oh, what worked for me in my youth will work for me in my senior years. No, it doesn't. No, it doesn't. You got to do differently. Don't believe the story, the lies that Wall Street has told about stocks and what stocks are going to do, right? Daniel, tell us about, there's one, and you already mentioned the name. I'm not going to mention the name again, but there's one person out there, a well-known person, that says, oh, take 8-10%, out of you're going to make 8-10% on your money, so you can take 8 or 10% out. Well, the market doesn't always do 8 or 10%. It doesn't always do 8%. You're not making 8 or 10%. And and this is a well-meaning individual, very sincere individual, very sincere, but he's living in the 80s and 90s mentally. He sat on a show where he learned finances in the stock market from a term insurance guy, from A.L. Williams, and, learned about investing in mutual funds in the 80s and 90s. Well, guess what? Investing in the 80s and 90s was totally different than investing today. And investing when you're 20, 30, 40, 50 years old is totally different than when you're 50, 60, 70, 80, 90 years old. And then you got, all these things, AI tells the incomplete story about income. And then what about that stock, Daniel? The 3 trillion market cap stock, right? It's
Well, yeah, I mean, NVIDIA, right? It's the darling. It's everyone wants to own it. I keep getting calls from clients, from friends. Should I buy NVIDIA? Should I buy NVIDIA? Should I buy NVIDIA? And I say to them, NVIDIA is an amazing company. And of course they're going to be needed for AI. But just because a company is a great company doesn't mean it's a good investment.
Right.
Right. And if you were going to buy
at that time, timing is another piece of that.
Right. If you were going to buy a business, because this is how we should look at stocks. Stocks are companies that you should be looking at cash flows. It shouldn't just be like, this is a good story, but stocks are stories, right? Stocks are stories, fixed income or contracts.
And it shouldn't be a gamble, from SM. Oh, this is a good gamble. But let me stop you there for a minute, Dan. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is retirement, why everybody wants income. It's all about the income. We've got a paper that we'd love to put in your hands today, because people don't know what people don't know, and we want to educate you. So we're going to give you this 4-page paper called Passive Income for Retirement, how you can have the income that you need, explaining simply what you need to know to know what you don't know, so that you can be able to live off the interest, live off the dividends, and not have to worry about your retirement. Lower your risk, increase your return for retirement. You can have that paper for free by calling us at 800-725-7616, 800-725-7616 for your free copy. Call now. You listen to Financial Strategies with Andrew and Daniel Agemy, and it's all about the income, why people want income. Okay, Daniel, so you were just talking about NVIDIA, and good company needs to be looked at as a company, not a gamble, not a bet, right? And need to look at the financials, all these things.
Yeah. And so as long as money keeps pouring into NVIDIA, it'll keep going up. Why is that? Because that's the way that our system is designed. People don't care about valuations. If you were going to go buy a business, okay, you decided, you know what, I'm going to get out of my current business and I'm going to go buy an HVAC company. I'm going to buy an HVAC company because trades, you can't hire good people to do work. So I'm going to go buy this profitable company. I'm going to earn $500,000 a year. I'm going to buy this and I'm going to pay paid $500,000 a year. How much would you pay for that company? Would you pay 30 times that $500,000? Maybe
Nope.
you're a really good manager and you could get that. So 30 times that means it's going to take you 30 years to pay off to get to break even, right?
Right. Not good.
Not good. Not good. Now, what if the company was a $3 trillion company? Okay, the rule of large numbers gets a little crazy because how they're making a lot of money, but how much money can they do? Can they increase? Can a $3 trillion company increase its earnings 30 times? I don't know the answer to that. And because I don't know the answer to that, I choose not to participate in that, right?
Good. Right.
Would you buy the HVAC company if it took you 30 years of working to pay it off?
Nope. No, not at all.
That's the same thing, right? It took you 3 years. Now you're like, that sounds a little bit more realistic.
Right.
So you have to think, you think it's going to double? What's a good investment? You think it's going to double? You think it's going to triple? So if it doubles, that's a $6 trillion market cap. Is that possible? It's possible someday. I don't know when we're going to have a $6 trillion company, but there's no $6 trillion company right now. If it triples, if it quadruples, right? You got to start saying, like, this is one company. The other thing is, if you believe in innovation, you don't think somebody's going to design a different chip, a more powerful chip, a chip we haven't even thought about. So that's where these valuations start getting a little complicated because you're expecting it to increase its earnings by 30 times to get your investment back. And in the meantime, somebody else can develop a better version of what they're already doing.
Right.
And that's when we're looking at retirement. You can have a bag for gambling, right? You can have a pile of money for gambling. And we have clients that do that. And we have clients that own NVIDIA and they're trying to trade it around it. And that's fine. They can do that. But they've already got the purpose put together. They've got the income on the other side and they have enough. So your pile should not be in those type of speculations, because if you don't believe me, call us up, ask us for the chart of the US stock market, right, since the 1800s, and you will see there's plenty of periods of time where it didn't do anything for up to 25 years. And that's a big part of somebody's retirement. People, when they say markets only go up, they mean over long periods of time. Long periods of time, right? It goes up and to the right. But a 15 or 20 year period of time where it's flat or down in your lifetime is a big deal. And over a 200-year span, it's not such a big deal. But over your lifetime.
And especially if that time frame is at the end of your life, it could ruin your retirement. And who wants to hear the words, oops, sorry, you don't have you ran out of money. You listen to Financial Strategies with Andrew and Daniel Agemy. Oh, Daniel, while we're talking about that, what's that company that just came back recently after like 25 years? They hit a high back in 99 or 2000. And
the darlings of the tech bubble, right? We had Intel and we had Cisco, and Cisco still has not. Cisco was the most valuable company. The most valuable company in the U.S., had the largest publicly traded company at the time, and it still has not reached its peak from the 2000 tech. And it sounds an awful lot like this company because you couldn't get anybody who was around remembers you can't get on the internet without the routers, right? That was the gateway to the internet, and people were right. And it was a great company. It is a great company, but the market cap got too big for its britches.
Yep. All right. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is retirement. Why everybody wants income. You need income in retirement. It's not about assets. It's about income to be able to do what matters most to you. Usually it's going to take income. And so today we're talking about this and how to get income. And we're glad that you joined us. We have a book we'd like to give you before we go to our breaks called Common Sense Income Strategies by our friend Michael Easom, talking about how simple investing can be for income if you understand what's going on. but people typically don't understand because the talking heads on Wall Street, the talking heads on TV are not talking about it. Even AI is not talking about it properly. So you can have this book for free. This will educate you. We'd love to put it in your hands. We're educators to be able to help you make good decisions. Common Sense Income Strategies for the next 5 first-time callers, 800-725-7616, 800-725-7616. You're listening to Financial Strategies, to Andrew and Daniel Agemy, and we'll be right back after this.
Time for some tough questions for these financial advisors. What makes Retirement Income Source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love. We gotta talk to these guys. We're done here.
This is Financial Strategy with Andrew and Daniel Agemy.
AAA, a few weeks ago, I was talking to an investor and he was looking for income. He was looking for income, trying real hard to find some, told the current advisors that he had that he wanted to be safe and he wanted some income. So they put him into a fund. This fund has $318 billion in it. That's a lot of money for a fund, right? And it's pretty awesome because it's only got a 0.05 expense ratio, right?
Wow.
So that must be great. We started looking at the fund. It's a bond fund. And he had lost since basically 2021, about 18% of the money. And have any guess what it's paying for dividends? I mean, that's why you buy a bond fund, right? To get income?
3%.
Well, right now, 3.3%. And so we went through what is this fund doing for him? It's not giving him security of principal. It's going to take years collecting 3.3% to get back, right? It didn't do what it was designed to do. And this is somebody who's working hard to try to get income for his retirement. I'm Daniel Agemy.
And I'm Andrew Agemy, listening to Financial Strategies with Andrew Daniel Agemy. Welcome back. And we're talking today about why everybody wants income. When you retire, you need income. It's not so much about the assets. The assets should be able to produce the income, the interest and dividends. And we don't want you to withdraw from principal in order to live your retirement. We want you to be able to have more than enough money income that you need to be able to last the rest of your life. And because people don't know what people don't know, Daniel, that's great. It's terrible. A great example. It's a great example of a bad example, in regard to what is happening with, what people are doing. They're looking at mutual funds. And like I said earlier in the show, you get what you pay for. Sure, you're only paying, very small amount, 5 basis points on this thing, if that much. But what are you getting for it? You're not getting anything for it. You're losing.
Well, it costs you 18% of your portfolio,
right? Over that 5-year period, or 4.5, or whatever the case may be. Plus, you're only getting half of the income. You're only getting half the income that you could be getting in something that's safe or that you wouldn't lose money on. And but the thing is, Daniel, people don't know what people don't know. So, AI, as we said earlier, AI doesn't tell people either. So right. That's why we're having the show.
Just for an example, if you bought this Goldman Sachs, so we take 3 globally systemically important banks, right? And I wouldn't suggest putting it all into bank, but we take 3 systemically important banks. We take Goldman Sachs, Citigroup, and JP Morgan. You put your money into those instead of this. Yeah. It's safer. It's got better contracts. It's tax efficient more, and you're getting paid more than double what you're getting paid in this.
Right. Amazing. Why don't people do it?
It's a good question.
They don't know. They don't know to do it, right? That's so what we've been talking about, Daniel, was this idea. This is so much simpler, right? Like the difference between, these things that you're talking about are more contracts, which have a safer point than equities. Then stocks don't have contracts, and you're not really guaranteed anything except the possibility of loss in stocks. You have the possibility of gains, but that's not a guarantee. But losses
and let's clarify that a little bit, because there's a lot of good stocks out there that have amazing risk reward potentials. When we're talking about stocks, we're talking about like a stock fund or an S&P fund or something like that, where the risk reward right now doesn't make a lot of sense. If we look back to the 60s, the PE was around 4. So that goes back to our story where it would take 4 years to get your money back. Now I think it's trading around 28 or so, which isn't the highest it's ever been, but it's pretty high. And so the euphoria or people's impressions of what's going to happen really affects when is a good time to be in, when isn't a good time to be in. So if we say it's at the higher end of the range, do we ever think it will get back to 4? Probably not, right? But at least a 12 or a 10 or a 9, right?
Yeah.
So if it's at the higher end of the range, that means it's more expensive than if it's at the lower end of the range. And if we know over 150 years, it's the 9.5%, then is it more likely you're going to earn more than 9.5%, or is it more likely you're going to earn less than 9.5% if the average is 9.5% and we're at the top end of the range? Right. That's what we're talking when we're talking about these. I don't want people to think that like there's no good stocks. There's a lot of good ones out there. They're typically not in the S&P, although some of them are. But that's what we're looking at when we're talking about this. We're looking at those risk rewards, and it doesn't make a lot of sense for the upside. Okay, sorry to cut you off, Triple A.
Okay, no, it's all good. But investing is simple, but it isn't easy. And the idea is you buy low and you sell high. The point that you were trying to bring across is that the market is high right now. It's not going to be as low as it, into that 4 range like it used to be, but it can be, and it will be lower. Will it be higher? Well, it may. So if you buy now, are you buying high or are you buying low? Well, we don't know. Only the future will tell. But when we're buying these simple things like bonds, preferreds, contract-oriented things, we know what we're going to make on the money. We're making the money when we buy them. We know what we're going to make, like in those examples you gave earlier, $700, $800 a year on a $10,000 investment. We know we're going to make that. And it's contractual from that standpoint. And that's what makes this way of preparing for retirement easy, simpler, but you have to know about it. You have to do it. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is why everybody wants income. And we have a paper to go along with today's show talking about the universe of income generating investments. And we love to put this in your hand. And this talks about those things that we're talking about that makes things simple. Now, the investment side is simple. How to squeeze the most amount of juice out of these things is not simple, but that's not for you. That's for people that manage money like Daniel that does from that standpoint, squeezes all the juice out of those lemons so that you can get the most bang for your buck and get the most multiples on the compounding. Like Albert Einstein said that compounding is the 8th wonder of the world. And so anyway, we have this paper for you. It's for years for free. Universe of income generating investments. These kinds of investments that are simple. Call us 800-725-7616 for your free copy. 800-725-7616 for your free copy of Simple Investments. Call now. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic, why everybody wants income. It's because people don't know what people don't know. So keep listening. You're going to learn something. Daniel, as we're talking about this, I mentioned Albert Einstein saying compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it, right? And that's
never been truer, right?
right. And that's what's happening with these companies we're talking about. Citigroup with JP Morgan that you're talking about, Synchrony with its 8.2. They're paying interest, and so that you can gain it, so our clients can gain that and have it compound, so that it can actually build bigger, right? And again, the compounding aspect is thinking of it in forms of this is chickens, and the chickens are laying eggs. You don't need the eggs. We take the eggs, we buy more chickens with the eggs, and then what do we get? We get more chickens. When we get more chickens, what do we get? More eggs. And so that's a beautiful thing that we can that people that our clients live off of in retirement. And that's how they have more than enough income to be able to live the rest of their life and to do the things that they want to do.
Yeah. Triple since we're talking about compound interest, how about you explain the rule of 72?
Okay. So compounding deals with, how things compound is using the rule of 72, right? So rule of 72, you take 72, and if you get an interest rate, let's just make it simple, right? Let's say you get a 7.2 interest rate. Well, you divide 7.2 into 72, and it's going to take you 10 years to be able to double your money, from compounding nature. 10 years to compound and double your money. So you invest $10,000. So Daniel, you were talking about some of those companies, right? Let's see here. Okay, so Citigroup has a preferred at 7.2%. And we take that we buy $10,000, we get 7.2%, and we take that 7.2%, $720 that we get every year, we reinvest it, and in 10 years, we have $20,000. Beautiful thing. If we're able to get 10% on something, well, we double our money in 7 years. If we get 5% on something, it's going to take 14 years to get it. So the rule of 72 says how long it takes when you're compounding to double your money. Now think about it for a minute, right? If you weren't compounding that would be a different thing, right? That $10,000, now you'd be, if you weren't compounding, you take that $10,000 and it's $720 a year. And over that 10-year period, that's $7,200. You haven't compounded, because if you're taking it, that's fine. If you need it, that's fine. Take it, right? But you're not getting as much as if you're compounding it, because if you left it in and compounded it, well, now it's going to turn into 20 grand in that same time frame. And that's what people don't understand, because typically stock market, S&P does not typically compound in any great fashion, right? I mean, when people are talking about stocks, the idea of stocks is $10 a share, $11 a share, $12 a share, $13. It grows by the share price growing, but it can also go the other direction. So compounding means that you actually have the money. Like when you go to the bank and you get 5% on a bank account, and 14 years later, you're going to double your money at that rate if you just leave it in there. But if, you put $10,000 in, you get 5% on it. And, 14 years later, you're going to have $70,000 or $7,000 instead of $10,000. You're going to have 17 as opposed to in simple interest, as opposed to 20,000 in compounding.
And where the Einstein part comes in is on your first example, you said the 7.2, you have $10,000. So in 10 years, you have $20,000. Pretty cool. So then another 10 years, you have $30,000, right? No, because that's the magic of the compounding. That's what it seems like. You'd have 30.
Yeah.
Oh, you've got $40,000 now.
Right, because it's your money doubling. It's not the dollar amount. It's not the 10,000 we're concerned about. It's the doubling. So very good point, Daniel, because I kind of stopped too soon, right? Because, I did it at 10 years, but you look at 20 years and that 20 turns into 40. And that's the big deal, because today, if somebody's retiring at 65 years old, especially if they're married, the chances of one of them living into their 90s is very good. And actually today, it's chances of both of them living into their 90s is very good. Actually, one of them hitting 100 years old is very good. So we're talking 35 years of being in retirement. I mean, it's possible today to be in retirement longer than you worked. It's possible. So anyway, you're listening to Financial Strategies with Andrew and Daniel Agemy, and we're just flying along here today. We're loving to tell you about things that you don't know. Why Everybody Wants Income is the title of today's show. And we have a book that we want to give you before we go to break called Common Sense Income Strategies by our friend Michael Easton. And this is going to tell you the types of investments that are simple for investing, where you can get and compound your money. You can get 6%, 7%, 8%. And compound your money over time, which is a different way of doing things when you're in retirement. Because if you're taking those eggs and eating those eggs in retirement, that's a beautiful thing, as opposed to eating the chickens or eating the roosters. So we'd love to put this in your hand. Call for the first 5 first-time callers at 800-725-7616 to get your free copy. Common Sense Income Strategies by Michael Eason. 800-725-7616. First 5 first-time callers. Call now.
The biggest mistake retirees make is not switching from the growth model to the income model. You know, a good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Triple A, we have a good client. He's been a client for a long time. And some of our clients have a good amount of money, and they have money at different firms. We're not the only person managing their money, right?
Right.
And he decided he wanted to bring over some money, some safe money that he had with another firm.
Right.
So he transfers it over to an account with us, and we start looking especially at this one position. They sold it to him as a safe bond that was going to pay him 6%, or I forget what they told him it was going to pay.
Right.
And it hadn't paid him, and he was wondering why. That's partly why he transferred it over. So we're trying to get information on this thing, and it's very difficult to get any information on it. So we finally got the prospectus, and we're reading through it, and come to find out, it has all these things where not only will you not get paid if they happen, you could lose your actual principal. So it's like, if the market doesn't do X amount, you don't make anything. That's why he didn't make anything. He didn't hit that target. If these 3 stocks don't hit this target, your principal could go down by 20%. If the market goes down by this, your principal goes down. And the thing was designed to take the risk off of the company that sold its balance sheet, the financial firm that sold its balance sheet, and put it on the retiree. And it was disgusting and it's terrible. But these things are becoming more and more prevalent. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And keep listening, because you're going to learn something here. Why everybody wants income, and income is it's all about the income when you retire and how much income that you can get. And what Daniel's talking about here in this example is that thing called a structured product. It was structured by the investment company that sold it. And you know who makes money on structured products? Not the retiree, the company that structures the products. And there's a ton of structured products out there. Now, the retiree could have read the prospectus himself in regard to that example, but he didn't, because who reads those prospectuses? You're looking for it to be able to, the people who are talking to you about it, be able to educate you on it. And when people who are selling stuff, they just want to make a sale. They don't want to educate. So it's all about the education.
I would bet money that the person who sold it to him didn't know how it worked either.
Exactly.
Because these are complicated things. And I don't think that the person who sold it to him would have lied to him that his principal was safe. I think the guy who sold it to him just didn't know.
I think it was very sincere. The problem is you can be very sincerely wrong, right? And that's what a lot of things are happening out there. And if a person, how many sincerely wrong advisors does it take to ruin somebody's portfolio and somebody's retirement? One. Oops, sorry. No, you can't say that in the medical profession, because it could mean somebody's life. And the same thing in the retirement profession, right? Because it could mean somebody's retirement. So a structured product is structured to make the investment company money, not the retiree money. But and Daniel's going to go into that. But the point is that when you're talking about a bond, is a debt instrument. And a bond is something, and this is why it's so simple. If you have ever had a mortgage on your house, it's a debt instrument. The bank loaned you money. The bank is going to pay you a certain amount or you're going to pay the bank a certain amount of interest. The bank knows what they're going to make. And a worst case scenario, what money they're going to get, that they're going to get their money back in a 30-year period of time or whatever the time frame that the contract states. And it's a debt that they loaned you money. So they're in control. And so you're going to do everything that you can to pay your mortgage. And if you have to go without putting gas in your car, you go without putting gas in your car to pay your mortgages. You don't want to renege on your contract with the bank, because they will not only take your house, but they'll take the equity that's in your house that you spent all that time. So you're going to do everything you can to do that. And so when you buy a bond, it's just the opposite. You're the one loaning the money, and the person paying the money is going to do everything they can. And that's where the contract comes in. So that's why it's simple. And the guarantee is that upon maturity, you'll get your money back. As long as the company is in a valid company, you're guaranteed to get your money back. That's what makes individual bonds safe, is the ability to hold them to maturity and get your principal back and make the interest all the way along. You see what I'm saying? It's simple. It's all about the income. It's simple. And you can have it too. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And we want to give you some more simple information. We got a paper for you about the universe of income generating investments. It's about 4 or 5 pages long, simple reading that you can understand how to simply invest for retirement. Now, that doesn't mean that you should go out and do it, because there's other facets that are involved that can make it compound faster and bigger for you. And so if you want 3 or 4% or 5%, okay. But if you want 6, 7, 8%, even 10% over time, safer than the stock market, well, that's where a manager comes into play. But we'll be glad to give you this book, this paper to educate you, called The Introduction to Universe Income Generating Investments. 800-725-7616 for your free copy. You're listening to Financial Strategies with Andrew and Daniel Agemy. 800-725-7616. Today's topic is, it's all about the income, right? Or why everybody wants income. Daniel, we just have a few minutes left in the show at this point for this week. And, people want income because it's something that they can live on, something that they can get, that they can do. The income is going to be that check in retirement, rather than it's pension, it's Social Security, it's coming from dividends and interest, something along these lines. Hopefully not a structured product, because they may not get their principal back. But
right. Well, there's this huge demographics. There's this huge demand for income producing instruments. People get it intuitively. They get that they don't want to spend down the retirement assets to have the lifestyles that they want, to have the retirements that they want to have. And so people are taking advantage of that. One is they're just telling them that S&P only goes up, and so you can take a withdrawal. And again, people intuitively know that isn't right, but people they respect or pay are telling them that, and so they believe that. The other is, which is maybe even more egregious, is all these companies that are putting together things like structured products, and they're getting worse and worse. So that structured product we gave the example of, that was the big kind of thing that was going on before. Now it will be, they'll have a fund that does this. So they're not even talking about trying to protect their principal. But what it will have is it'll have a huge dividend on it. So people will screen for big dividend funds, and it will be like an 8 or 10%. I've seen 15, 40% incomes, right? And what these things do, there's all different ones, but a lot of times what they do is they go look for the biggest pieces of garbage of companies out there, because they have a lot of volatility. And then they buy and sell options on these things to generate income. And then they pay you the income. And as long as it's working, you're getting your income. But if anything goes wrong, like in COVID, a ton of these things blew up and they went away for a while because there was too much volatility and they all blew up. But now they're coming back. And so these are huge risks. Bond funds are more risky than people think too. We talked about the bond fund that was supposed to be safe, that people since 21 lost 18% and barely earned anything in income. But with corporate bond funds and things, you don't know what the cash flows of the companies are. You're trusting that an agency picked a good rating. Now you can get actively managed bond funds. That's a better thing than buying a basket or an index of bonds, because index of bonds is almost the worst thing you could do with bonds, because nobody's doing due diligence and they have to put more money into the bigger market cap ones, which means if it goes above par, they're buying more, which means your principals, you're earning less, right?
Right.
But no, you want to do, like in your example, AAA, you said the bank has the contract and they make all the rules. They get to decide. You know what? One thing you didn't mention that they mention, they pick the person that they're going to give the money to.
Right.
They do a credit check and they see if you're worthy of having a loan. A lot of these bond funds are not doing that. They're just looking at if it's investment grade or non-investment grade. And that is not good. You need to do a credit check. You need to check the credit worthiness of the company. And in all bond funds, you give up the two most important factors, which is, you know when you're going to get your money back and you know how much they're going to pay you. And those are the two most important guarantees on a bond, that you know when you're going to get your money back and how much you're going to get paid in the meantime. And that's why we continue to talk about individual companies, individual stocks, individual bonds, individual preferreds, individual business development companies, individual royalty and streaming companies, individual real estate companies, right? We like those because we can go in and we can check if they're credit worthy and if we think the risk adjusted return is worthy for our clients.
Right. And that brings in the point of the whole point of managed money, right? When we're talking about managing bonds and bond-like instruments, it's taking advantage of opportunities where we buy it at $24 a share, it goes up to $27 a share, it pays 6% interest. We sell it at 27 a share. We buy something that's going to pay 6.5% interest for $24 a share. Then that goes up to $27 a share, right? And we make money from growth and from income. And that's where the compounding takes place to get a double-digit return over time with less than half the risk of the stock market, right? But you have to know something that you don't know in order to take advantage of that. And that's why you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what they don't know. And there's a different way of doing things. There's a better way of doing things when it comes to retirement income. Nobody's going to provide you more retirement income in retirement than us. Others might be able to match it, but nobody's going to get you more than what we can from your investment, more eggs from your investment. So we have a paper or we have a book as we round out today's show, Common Sense Income Strategies, that will explain to you how we do these things and how you can do these things, or somebody should be doing these things. Investment advisors out there don't know how to do this stuff. We talked to one person that went around to all these different places trying to find somebody that knew about income, and they didn't know about income because I didn't tell them about income. Their companies are telling them about income because their companies don't make money off of this. They make money off of other things, and that's what they want them to concentrate on. They make money off of structured investment. But here, we're not talking structured investments. We're talking simple stuff, folks. Common Sense Income Strategies by Michael Easom. To the next 5 first-time callers, 800-725-7616, 800-725-7616. We've been listening to Financial Strategies with Andrew and Daniel Agemy. Because people don't know what people don't know. We want to educate you to be able to make smart and wise decisions. Today's topic, retirement. Why everybody wants income. You want income to be able to last the rest of your life, to be able to live and not have to spend on your principal so that you don't lose money and that you're able to hang on to what you have. Well, call 800-725-7616 for your copy of Common Sense Income Strategies for the next 5 first-time callers. And we will look forward to helping you to become stress-free in retirement.